Welcome to Central Bank Central. I'm Kathleen Hayes. 2 weeks ago, the Bank of England met. It held its key rate steady as expected in the narrowest of votes. Today, the latest inflation report shows the expected improvement in inflation, which is making many people wonder, is the Bank of England going to be much closer now to doing a rate cut, maybe as soon as March? Today, I am joined by a very special guest. Catherine Mann is a member of the Bank of England's Monetary Policy Committee, the one that just met, someone I have known for many years in many roles. And it's just, Catherine, such a great pleasure and honor to have you on Central Bank Central. This is great.
Well, I'm really happy to be with you too, Kathleen. It's a great podcast, and I'm looking forward to be part of it.
Ooh, well, see, it's time. It's about time. Well, let's get going here.
Yeah.
Inflation, month of January, fell to 3.0% from 3.4. That was the forecast. That's a nice big move down. The core rate also down to 3.1%. But bottom line, those numbers, while a great improvement, are still far above the 2% target. So did you wake up, look at the numbers today and say, oh, okay, maybe I'm going to think more. Maybe I've got more information I need to be in favor of cutting rates at that coming meeting?
So the last meeting, some of the information that I thought was important for my decision going forward involved looking at the 1 year ahead decision maker panel. In other words, we have this panel of firms. We ask them quite a range of information on a monthly basis. And they also tell us about what they are not just doing in today's month, but what they think they're going to be able to do a 1 year ahead. So we asked them about their pricing strategies and we asked them about their wage settlements. And that information really does represent a forward-looking assessment of what firms believe that they're going to be able to do 1 year ahead. Now, that's the time frame that central bankers need to be thinking about. So that information for me was pushing me closer to being confident that within the time frame of the monetary policy horizon, we would be hitting 2% on a sustainable basis. Wasn't sure yet, but these were important. There's important information in the distributions of these responses, especially as I looked at, for example, consumer-facing services and consumer-facing activities. That's really where consumer discipline of pricing strategies is most important. How does all of this information show up in the data that we last saw today? These are good numbers from a headline perspective and also from core, both improvements, but more improvement on headline coming from transportation energy prices, which of course have been somewhat better in terms of contributions to the headline inflation rate. Now, with respect to core, the good news, yes, but not quite as good as we had hoped to see. We thought we would be a little bit below 3 for that, and also not quite as good on services as we hoped to see, 4.4 instead of 4.1 in our last monetary policy report. So yes, good news, not quite as good. Now, another piece of actually quite good news, 2.2 down to 1.6 on goods. Now, this is very important because
Yes.
when I do my analysis of the decomposition of CPI inflation, and I really think we have to look at decompositions here. You know, the aggregates are interesting. Decomposition tell you where you're going
Yes.
and how far you need to go before you get to sustainable 2%. The goods price inflation was something that was quite of a concern to me because it was far away from what I saw as target consistent. So in some sense, that type of number for 2.2% down to 1.6% on goods is actually even better news than I had hoped for.
So boil it down. You in your statement after the meeting, you
Mm-hmm.
get, each member of the Bank of England, the board, gets to have a nice long paragraph, right?
Great.
It seems to me that the sense I got from you was, yeah, I'm looking for the data to move enough to go ahead and say, yes, okay, let's make another rate cut. Um, does this take you a little bit further in that? Did I hear your voice right in that paragraph? And does this make you say, "Ooh, gosh, yes, Kathleen, we are getting closer"? And then I have to say, what are you waiting to see to make the move?
So at my paragraph, these 200-word paragraphs are an innovation. This is the second time around that we've done the 200-word paragraphs, and they are a good discipline to really, crystallize your thinking in a very brief way, what it is that you see and what you need to see. So in that paragraph, there were a couple of points that I made. I think one important point that needs to be emphasized is that it is quite likely that we will get to 2% in the next 3 or 4 months on account of the types of um, uh, changes in administered and regulated prices by the HMRC, by the Treasury. And I think this is important to recognize that these are one-off changes. Just as a year ago, we had one-off changes that materially increased headline inflation. So if we look at the delta, the change from the peak of inflation or the local peak last year to where we are likely to see as a trough, about half of that change is coming from changes in administered and regulated prices. That means it's actually pretty hard to tell exactly what is the sustainable or underlying trend rate of inflation and whether or not the 2% that we are likely to see coming forward in the next few months is in fact a sustainable 2%. This is why I think it's very important to look at this 1 year ahead information about both wages and prices from our decision maker panel. We have to remember inflation comes from the decisions that firms make about what their prices what they would like their prices to be, and then in relationship to what their prices are going to be, considering whether or not consumers are going to pay the price. So firms might like to have a price of a certain price inflation rate, but if consumers aren't willing to pay that, or they can't pay that because they perhaps unemployment or other factors, firms are going to be disappointed. So 1 year ahead is a very important piece of information. The distribution of those responses is a very important piece of information, because if that distribution is very tight 1 year ahead, firms are pretty confident. If it's wide distribution, they're not so confident. And so both of these, both the 1 year ahead figure in the mean, as well as the distribution, are important ingredients. I'm going to see a couple more pieces of that information about the 1 year ahead, and that will be a key ingredient for the decision. We also, of course, have to consider the consumer pricing discipline side. In other words, consumers are the ones who discipline pricing strategies. Right. The savings rate is a very important piece of information. It has come down a little bit, from quite high double-digit rates, not usual for the UK consumer, the UK household, but it has come down just a bit. I will need to see more information about whether or not consumers are going to open their pocketbook or are really still quite conservative.
So how often do you get the decision makers panel? And just be a little more specific now about the last panel reading, what they told you, and how these things that are so important to you. You just made me the list. Well, what did they look like then? Is it a wide distribution? Do you get a more of a definite sense that they're figuring, that they need to cut prices now because they want to sell stuff, right? I mean, what was that one, and when is the next one?
So we get it on a monthly basis, and we will get certainly one more, perhaps two more, before the next meeting. So I get quite a bit more information. The distributions were fairly tight in the last round. But they were moving in the right direction. In other words, we would like to have the whole distribution move to the left, and that was certainly the case. And as I say, I particularly look at the distribution of prices for what I see as the most income sensitive, the most price elastic type of categories. And that would be your consumer facing restaurants,
Mhm.
hospitality,
Mhm.
mother
Right.
services, and some of the goods components. It was interesting, I think, in the data that came out today that restaurants, hospitality were basically had just a slightly positive, but basically zero inflation rate, and that to me says that consumers
Wow.
are disciplining the
Yes.
pricing strategies of that very price elastic category of.
Oh yeah, and so it's so up to date. It happens all the time. We
Yep,
go to restaurants. It's like we
right,
buy a car every few
yep,
years, or
yep,
a new sweater. Yeah, that's a very I would think that's a
yep,
very significant one. In all the work, and I would like to recommend to everybody who is not as familiar with your work, the speeches you give, the studies you do for the Bank of England. There's a lot of readable, understandable research, I think, and you've written so much about inflation, a great one last August, for example, and then something in October. But anyway, you have argued that you're big on inflation expectations. Just about every central banker is.
mhm.
So you've also said that you want to make sure the inflation expectations remain anchored. So, and there, what's the risk though, potentially holding rates too high for too long? And is that coming down now, do you think? Are y'all getting more? Are the other five who didn't vote for the rate cut at the last meeting, are you five then mostly getting more on the side of, yeah, it's time, and we're not so worried about de-anchoring inflation expectations?
Well, I can't speak for my colleagues. In fact, they have spoken somewhat over the last week or so since
Yes, they
the
have.
meeting on their assessment, and of course their paragraphs have a few things to say too.
Yes.
Inflation expectations are very important because they are a key ingredient to both the capacity of firms to price their products. People think inflation is going to be high, then they're not going to be surprised when they go into the shops and they see a high increase in the price. So, inflation expectations are very important. I think a key question, and is a critical question about the inflation print that is going to come in on expectation over the next few months. This, as I said, this will be a significant drop on account of basically 50 basis points, a little bit more, being taken off associated with the energy price caps for households, as well as a number of fuel duty issues, some water charge, and a variety of things that are administered prices. These are decisions. They are not market decisions. They are.
Mm-hmm.
And however, those that ingredient may well. The question is, to what extent does that data, when it comes in on inflation, translate into 1 year ahead household inflation expectations, and even, of course, more importantly, 3 year ahead inflation
Mm-hmm.
expectations. We will get some information. We get it from a couple of different sources on inflation expectations at different time horizons. So we will see some information about that. Another factor that I think is very important and was in today's print as well, that food inflation had decelerated. So this is an important, probably the key ingredient in driving short-term inflation expectations. People go shopping all the time; they really know
Mm-hmm.
kind of what the prices are doing, and so food inflation is particularly salient. So watching that is again a key ingredient in my decision making.
So, in terms of the economy, the economy is still struggling to grow,
Mm-hmm.
um, and you're still trying to push inflation back down to target.
Right.
Um, how is that going to fit into your deliberations, your next decision? Is it kind of like well, if inflation is going this far down and getting this much lower, moving in the right direction, and you expect it to go to 2%. Does that then put the focus much more on the economy, much more on why you need to cut rates to get that side of the equation correct?
So over the last year, this challenge of inflation going one way, because of course last year in the early part of the year the inflation rate was rising, right? For a variety of reasons, including those administered prices. So you had inflation rising, you had the labor market deteriorating. So the tension between those two parts of what we look at, among a variety of other things, of course, but those two, that tension was increasing over the course of the year. Where we are now is there still is a problem of inflation being above target, and the labor market is tepid or weak. Although in some respects there are some interesting aspects below the headline numbers that I think we have to be aware of. On the other hand, some of our forward-looking indicators of business activity have improved. So if we think about three different things to look at, inflation and pricing strategies and wages being one set of things, then we look at GDP, we look at market sector output being a second set, and then we think about labor market characteristics. One of the challenges is to evaluate the state of the economy in terms of activity through the lens of output on the one hand, lens of labor on the other hand. For quite some time after COVID and then after a variety of other shocks, we were looking at a labor market where we talked about labor market hoarding. And we talked about firms being concerned that they would, if they didn't want to fire anybody because they weren't so sure they were going to be hiring again. That takes us back a couple of years. However, where we are now is firms basically say, we probably are about right in having employment levels. We probably aren't going to backfill over attrition. Again, when we talk to the DMP, and we use that survey. We also talk to our agents, which is a different source of information at the firm level. We're looking at firms that are saying we're basically okay with our labor. There's always skill mismatches and so forth, but we're pretty much okay with labor. On the other hand, when we look at output, two different categories. One is GDP. The other one is market sector output, so business activities. There has been a disconnect in the UK economy for several years now between GDP, which has not been growing rapidly, but at least has been growing, and market sector output that has basically been flat for several years. So I think it's very important to try to gauge the sort of progress on wage developments and progress on pricing developments by looking at this package of the private sector, while as private sector wage developments, private sector employment, and private sector pricing. And on all those three, there is more of a convergence. Private sector pricing coming down, private sector wages coming down, and private sector output being flat, and private sector employment being basically flat. So that sort of points to a type of position where consumers are disciplining pricing, labor market is disciplining wages, and we are closer to being at a trajectory to get to a 2% overall inflation I see it as a relatively soft landing for the private sector. Okay. And then there's another player in here, and I think that other player is an important one to consider for the overall headline numbers that we often see. Headline wages, headline beating GDP, and headline inflation. We have to think about that other player.
Kind of stepping back and asking a big picture question, but it has a lot to do with growth, right? The
Mhm.
UK Office for Budget Responsibility has treated the pandemic, they've referred to as leaving the level of potential UK output permanent lower, creating economic scarring. That's what you have said as well. I think you've said Brexit actually has had a similar scarring impact on the economy. So, how significant are do these two big forces remain now, a few years later, on the economy? And is there anything the Bank of England can do, needs to do to help the healing process, help move things ahead?
So there are three elements of the supply side of the economy. There's TFP, or productivity growth, not labor productivity, but overall productivity, technical progress, if you want to call it that, business investment, and the labor force. And all three of them have difficulties in the UK, significant difficulties. And so we're not firing on really any of our engines on the supply side. And this is a significant concern because, of course, lacking supply side growth, it limits the room to maneuver for me as a central bank. And it represents, we call it, sometimes we call it the speed limit of the
Mm.
economy. And the speed limit is pretty slow. Um, and as I said, I would prefer to be driving a race car. Right now,
Yes, yeah.
we are not driving a race car. And the UK has done that in the past. It has innovation, including in race cars. It's called British Racing Green for a reason. So there is the capacity to do this in the UK to change the trajectory of the supply side. The role for the central bank to do that, to the role it plays, is much more limited. Um, in part because, for example, there's not much we can do about labor markets, the skill level, the matching. This is not really a monetary policy. Now on capital investment, a number of people talk about, of course, the Bank of England can play an important role in capital investment. You lower interest rates and more firms engage in cost of capital. In fact, I've done a fair amount of research on business investment in the UK, and it is surprising how inelastic business investment is to the interest rate. We can play a role at the short end. That's what our policy tool is, policy rate, bank rate. But the actual investment undertaken by firms is at at upper end of the yield curve. And in fact, a lot of firms use a hurdle rate, which is pretty much unrelated to bank rate. There's a whole different set of questions, but it also means that there's relatively little that the Bank of England and monetary policy can do to affect business investment. And of course, innovation, technical progress, we have lots of potential in the form of AI. A lot of discussion about that, of course. But again, role for Bank of England and monetary policy, the tool that we have, which is bank rate, is pretty limited. So we really have to focus on the demand side, and this is where, in my speech about consumption in the summertime, I noted, I channeled back to Alan Greenspan, who I worked with when I was at the Federal Reserve Board of
Yes.
Governors, that we know we've reached our objective of price stability if households and businesses don't make decisions based on inflation. We know price stability is achieved when inflation is
Yes.
no longer an important ingredient in the decision-making process for firms and households. We're not there yet in either case. We're headed there, but we're not there yet. And so I argued in that speech that one of the factors that was relevant for my decision-making, and it continues to be that, is we have to get inflation to 2%. If that means I have to hold for longer in order to get inflation expectations anchored maintained at 2%, then I'll have to do that. We've had our conversation here. extensively about output, market sector output being flat, labor market being tepid, consumers being holding precautionary balances. And I'm certainly aware of that. But part of the reason why consumers are holding precautionary balances is because they have been scarred by high and variable inflation. So,
Yeah.
so I have to be conscious of that.
So, and I'm glad you mentioned that's one of your very important speeches, the research, and again, lots of again, research things discussed and explained in a way that I think they're readable, they're understandable, right? It doesn't like one of the econometrics and all kinds of stuff that's going to make people who aren't economists like you. But no, that was another one I got a lot out of. Let's say March comes around, and let's say that the data look like okay, everybody's going to be on board for a cut this time. But will that mean that's because what you're making me think about is this work this sense that the people do kind of get scarred, the pain of a big jump in inflation and prices, particularly the lower end of the the income spectrum, does stay with you. So if you want to make that balance, does that mean this will continue to be a kind of a step-by-step policy that even if inflation is getting down to 2%, that you'll still be wary of just how quickly you push the rates down?
Well, my approach in the past has been to hold for an extended period of time and then make a large adjustment so as to communicate my view of the appropriate stance of policy in an environment where there's quite a lot of financial market volatility and noise. Um, you know, I think, an important question right now. We have the committee as a whole has made quite a few adjustments, steps down in the policy rate. The preference, of course, for the committee has been to make those step downs in 25 basis point increments. We are getting close to some sense of where monetary policy is balanced between the inflation objective and full employment. The balance right now is we're not at full employment for sure. There are many more people who are looking for a job than we're about balance in terms of vacancies and people who are looking. But in terms of the unemployment rate, of course, that has gone up, and that's a concern. Very much of a concern because now there's a potential. I talked a lot about precautionary consumption, precautionary savings balances because of the scars of inflation. But of course, it is well known that consumers and households will hold a precautionary balance if they're concerned about becoming unemployed. So in fact, that distinction is a key ingredient in my weighting of WEI, GHTING, my weighting on waiting, WAITING. So these are
Okay.
important pieces of information in my overall data set.
Kathy, I want to ask you some more, kind of a broader set of
Yeah.
questions. And since you said put so much emphasis on China raising export prices to the UK, of course, that makes your import prices go up, um, and of course, in tariffs in the US driving that. Is that going to remain? Is that going to fade? I mean, I think was everybody goes, oh yeah, the US fault. You raise tariffs, it gets pushed around us and our import prices. Are you worried about that? Is that something you think that if you look at where the geopolitics are going, or whether that this is something that is kind of going to fade out and just help that inflation rate come down, or do you think that's going to hang around for a while?
So in terms of China prices, the correct thing to say is that export prices to the United States have been falling. Global export price, if we think of global prices and then divide it up into to the US, to everybody else, global export prices to the US have been decelerating. Global export prices to the rest of the world have not. They've moved in the opposite direction. And so in the UK, there are a couple of different factors going on. If we just look at China prices into the UK, China export prices are decelerating. But again, there's this we used to think of there being one global price and everybody paid it. And the only thing that might make a difference about how much you paid was your exchange rate. That's not a complete assessment of what's going on with global prices today. There is this bifurcation between global prices as they go to the United States and global prices as they're going to other Europe, other advanced economies, including the UK. So there is some strategic pricing behavior that appears to be part of the global export price landscape. More work needs to be done to evaluate how any of these prices translate into something facing the consumer. I've said before that it's one thing for the price of a product at the dock, and then a different price when it hits the shelf, because the share of the shelf price that comes from domestic transportation and advertising and all the other things that go into a product, that is all a domestic price, and so we have to be thinking about those as well when we try to translate global factors, pricing factors, into domestic pricing factors.
Um, Gold, globally, gold prices have surged and they could come off the highs, but that's a big trend that's still there. Um, big question. Is that partly a vote of no confidence in global central banking? I mean, what is the investment world telling us? Well, what are you worried about? What are you worried about? Why do you want to get into gold? Uh, I know it's kind of an extreme question, but what do you make of that? What is it telling you as a central banker, or just telling all of us?
I think there's been some evolution in view about the dollar as a safe haven currency. I'm not, presenting any new news with that comment. And so when people are uncertain about, are risk averse, gold is the place they go. Also, the Swiss franc,
Yes.
you can imagine that. And in some sense, quite a few currencies have gotten some positive spillover. There's a generalized appreciation of currencies against the dollar. And so, everybody's getting a little sprinkling of capital flows and appreciation of their currencies as there's been hedging and other exit activity from dollars in particular. I do not think that prices of gold are a reflection of central bank credibility. Not at this stage. I think the credibility of central banks is quite high. We've got the European ECB in Europe pretty much at target. We've had the Reserve Bank of Australia showing gumption and going against the tide because it's appropriate for their country to be doing that. So central bankers are acting as they should be in light of the conditions in their own economies.
Okay. Well, I want to ask you another, because you have been, you were at an event recently where you spoke a great deal about the pound sterling and reserve
Mhm.
currencies and the dollar and the history. But you've described a long erosion of sterling's role as a global currency, talking about again, Brexit and fiscal turmoil. So what policy mix do you see as how should I say this, the most effective, I guess, to rebuild confidence in the pound over the medium term? And is that an issue? Do you think it's just something that they're kind of in history, or is it something that you're actively watching and thinking that it's going to be maybe some kind of measure of what's succeeding and what isn't?
Well, exchange rates, because they are a ratio of two, basically two sets of market assessments of a country's overall real and financial package. You can have an appreciation because you're doing great, or you can have an appreciation because the other package of the other currency is maybe not so great. So you always have to think about currencies in ratio terms and evaluate it, against, if it's a bilateral against the other country. That's the approach, and we really have to look at these things in the global environment. So the commentary that I've made about sterling as a reserve currency and how it, of the evolution from it being the principal reserve currency back in the late 1800s, 1900s, and to where it is now, which is a relatively lower share of 5% basically of international reserve holdings. The commentary there was to assess, to show that erosion isn't a steady one, that erosion has episodes of step downs. Those step downs in the past for UK sterling have been associated with periods of fiscal distress, periods of which in some cases have come from wars, World War I, for example. Those are associated with periods of changes in financial market health, shall we say. One of those step downs is associated with the rise of New York as being a financial center, again, post-World War I. And then other times there's been erosion, a step down in the share of the sterling used as a international reserve currency associated with changes in international alliances and trade relationships. And that happened when the British Commonwealth became the Commonwealth. And I think that those geopolitical assessments are important to think about in today's climate. And then, of course, you can have erosions and step downs having to do with your allies not willing to kind of come to your aid, both in terms of geopolitical as well as financial. So Suez crisis in the case of the UK and sterling. So I think we have to think about these changes in international reserve status as associated with both alliances as well as by domestic fiscal choices, and also what's happening in the rest of the world in terms of the rise of other countries in terms of economic activity and so forth. So, is it important that the UK is it relevant for either the UK or generally, or me specifically as a central bank, that the sterling is only 5% of international reserve currency? That's not something that I focus on. I don't think it's important. That share is not important for monetary policy decision making over the monetary policy horizon, because, as I say, the step downs tend to be episodic and associated with not monetary policy issues, at least for the UK.
Let me ask you one more question. Again, it's a big picture, and it's something that the world is more and more involved in, and that's the fiscal side of everything. And of course, Liz Truss at one point, made a kind of a misstep on the fiscal bounds, paid a price. France, its fiscal policy is clearly hobbling many aspects of what they can and can't do in terms of the government spending, et cetera. And the Fed is potentially pressured now as Jay Powell leaves and a new Fed chair gets ready to come in to cut rates to ease the U.S. financing burden. Again, as this is a bigger than just the UK question, but for someone who is an international economist who's worked at the Fed, worked at OECD, so many places, is this an age of fiscal dependency? And what does it mean for policymakers like you? Does it not necessarily that it affects you directly, but even just the economies, even the global economy? What do you see there, Catherine?
Well, I'm concerned that you use the word fiscal dependence. It is certainly an environment of fiscal activity and fiscal expansion. We are seeing that in a number, quite a few places, not everywhere, but in the advanced countries. And of course, there are some countries where having a little bit more fiscal activity and fiscal spending is a good idea. For many years, for a number of countries, it's the right thing to do for fiscal expansion. So it's the word dependence, and I think the issue twofold. One is if an economy is dependent on fiscal spending in order for growth, that is a concern. Fiscal spending and fiscal activity should be a catalyst for private sector activity, because ultimately it is private sector activity that is the source of both the supply side gains of an economy as well as sustainable demand. So we have to be talking about fiscal spending catalyzing the private sector. So that's the first variation on the word dependence that I would emphasize. But
Okay.
the second one is in sort of an innuendo, which is that central bank decision making and monetary policy will be dependent on the fiscal side of the economy, or we'll have to be considering the fiscal side of the economy.
Mm-hmm.
And again, that implies that the central bank independence is at risk. And we can think of a number of channels through which people have made assessments that, oh, well, central banks are thinking about, the interest payments on the sovereign debt, whether it be held domestically or foreign holdings of the sovereign instrument. In the central bank independence depends, it's critical. What's the remit? In our case, in the UK, the remit is inflation. And that's what we're focused on. And so things that affect inflation positively or negatively are the things that we have in focus.
All right. Well, and we got a lot out of you on that, didn't we? Thanks so much, Kathleen. It's been so great to
Yeah.
have you on Central Bank Central. First time. You'll be welcome back anytime.
Thank you very much. I've enjoyed our conversation very much.
Well, thank you. And I always might enjoy my conversations with you on Central Bank Central or not. Catherine Mann, of course, a member of the Bank of England's Monetary Policy Committee.
Thank
I'm
you.
Kathleen Hayes, and this is Central Bank Central.